Welcome back to our channel and the continuation of our series, The 6 Essential Elements of Successfully Selling a Business. So where are we on this? Well, in part 1, we discussed preparation and planning of the business and of the owner. In part 2, it was listing and marketing. And in that part, the marketing aspect was more important because what you do for marketing, the materials that you develop and how you handle the marketing process is going to go a long way toward determining whether or not you'll be successful in selling your business, and certainly how long it will take and how easy it will be. Part 3, well, that was the offer, an LOI. How do you negotiate that? Part 4 was on due diligence, how invasive it's going to be, and what you can do to prepare for it and make it as painless as possible. And this is part 5, structuring the deal. So what does this mean? Well, a buyer offers you $5 million for your business, and it's a number you like. It's one you can live with. So far so good. But what happens if only $3 million of that is paid at closing? What happens if a good portion of the purchase price depends on the future performance of the business? What about if you're financing, to greater or lesser extent, the buyer's acquisition? And what about the IRS? What if they take far more money from your proceeds than you had anticipated and had budgeted for? In many cases, if not structured properly, that $5 million offer will not bear even the slightest resemblance to a $5 million deal. And this brings us to one of the most important concepts in selling a business. And it's a phrase you'll hear me repeat several times in this video. The headline number gets your attention, but deal structure determines your reality. Now, properly structuring a deal is where sophisticated buyers often make their money and where inexperienced sellers often lose theirs. This is where risk gets allocated, taxes get determined, financing terms are hashed out, and where the sellers finally realize how much money they're actually going to walk away with. Deal structure determines how the transaction is legally organized, how the purchase price is paid, who carries what risk, how the transaction is taxed, and much more. And when structuring a deal, it's important that you remember that the parties, the buyer and the seller, each want different things. One will want an asset sale, one will want a stock sale. And so let's start with one of the biggest natural and structural decisions in any transaction: determining the overall type of deal. So there are two basic ways to structure the overall deal: asset sale and stock sale. Now, under each of those, all the subcategories are the same, and they all need to be paid attention to when structuring it. But the big decision has got to come out of the box. Do we want to do an asset sale or a stock sale? In an asset sale, the buyer purchases selected assets of the business, but not the entity that owns those businesses. Now, for example, if you've got a trucking company, ABC Trucking, and XYZ Trucking wants to buy the business, they will buy in an asset sale the trucks, the furniture, the employees, etc., but they won't buy the entity. They won't buy ABC Trucking, though they probably will buy the logo and intellectual property. But note that I said selected assets. The buyer chooses which assets he or she wants to have included in the deal. So how does this work out? Well, first off, understand that most asset purchases involve most of the assets of a business. But let's take equipment, for example. If you have a bunch of equipment stored in the warehouse or in a back room somewhere, it hasn't been used for 3 or 4 years, the buyer's not going to be interested in that, whether it's on the balance sheet or not. The same is true of the inventory. If some of it's outdated or it's damaged or even fictitional, then the buyer's not going to want that. But they're going to look and want the customer list, all of the contracts, all the intellectual property, or most of that intellectual property, and certainly the goodwill. And bear in mind that an asset sale is by far the most common structure in the small and lower middle market transactions. Buyers often prefer asset sales because they reduce risk. The buyer wants to avoid inheriting problems. They don't want any tax liabilities when they buy. They don't want any lawsuits. They want to avoid employment claims, regulatory problems, and any unknown obligations. In effect, the buyer is saying, I want the business, but I don't want your baggage. And frankly, from the buyer's perspective, that is not an unreasonable position to take. Now, a stock sale, on the other hand, is a transfer of the entire entity, the whole enchilada, the good, the bad, and the ugly. Sellers often prefer stock sales because tax treatment is usually better. And a stock sale is generally, well, it makes a transaction a lot simpler. Contracts and leases, licenses, all of those will transfer more smoothly as a rule, often without any renegotiation. And assets, they don't need to be retitled. Go back to our example with the trucking company. If XYZ is going to be acquiring ABC, but they want to do it as an asset sale, every one of the trucks, the 50 trucks that ABC has got on the road at any given time, will have to be retitled. All of that costs money and time. But buyers, especially sophisticated ones, resist stock sales because a stock sale generally transfers more risk from the seller to the buyer. Now, here's an example. We worked with the owner of a regional service company who strongly preferred a stock sale because his accountant indicated that there were tax advantages. But during the due diligence period, the buyer uncovered several payroll tax issues, though they appear to have been corrected a number of years ago. So even though the issues had been corrected, the buyer became uncomfortable and started getting cold feet. Buyers don't want to inherit such exposure, and tax exposure is one of the biggest fears of most buyers. As a result, the transaction ultimately closed as an asset sale. Now the seller paid more taxes than he anticipated originally, but the deal closed. The buyer was going to walk. The lesson here is that sometimes the perfect structure in theory prevents the transaction from actually happening in reality. Understand the difference between an asset sale and a stock sale. In an asset sale, the assets owned by the company are transferred to the buyer. Most likely, the liabilities are not. In a stock sale, the entity is transferred to the buyer, and that includes all of the liabilities, known and unknown. Remember, the headline number gets your attention, but the deal structure determines your reality. Now, deal structure is really about allocating risk. Every transaction involves one central question. If something goes wrong after closing, who pays for it? This is where representations and warranties come in. In the acquisition agreement, and in many cases the LOI, there will almost always be a section styled representations and warranties. This is where the seller makes statements such as, well, the financials are accurate, taxes are all current, there are no undisclosed litigation issues, contracts are all valid, assets are all owned free and clear, etc., etc., etc. These statements are referred to as representations and warranties. You're representing that certain conditions exist, and you're warranting that they will exist at closing. If they later prove inaccurate, the buyer may come back to the seller for compensation. This is where indemnification comes in. Indemnification simply means that if your statements turn out to be false and the buyer suffers some kind of damage, you make the buyer whole for whatever damages they incurred. This is one of the main reasons that legal documentation in business transfers is so extensive. Now, another area of concern that is very important in structuring the deal is how will the price be paid? Buyers often request escrows and add-backs. For example, a buyer may hold back 10% of the purchase price for 1, 2, or even 3 years after closing. Well, why would that be? Well, it's to protect themselves against maybe undisclosed tax problems, customer disputes, compliance issues, hidden liabilities of all kinds. Now, needless to say, the sellers dislike this and are often offended by the request. But from the buyer's perspective, this is simply risk management. A buyer will always assume that every deal, no matter how many deals they do, every deal will contain certain unknowns. This is really the only way to protect themselves from those unknowns. Now, assuming nothing surfaces during the holdback or escrow period, the seller will eventually get whatever amount was held back. But such holdbacks are tantamount to the buyer holding and using your money, and you could reasonably be expected to be paid for that. This is a question of negotiation with you and your broker. But financing in general, how the transaction is funded, is another major aspect of deal structure, because in the Main Street and lower middle markets, seller financing is common. Very few deals are done all cash. Seller financing is extremely common, and contrary to what many sellers think, it's not necessarily a bad thing. In fact, it can be positive. It can potentially increase the buyer pool. When seller financing is available, more buyers come out of the woodwork. They feel that they could afford this business. It can often increase the price. Seller financing is worth something, and if you're going to do some seller financing, there is value that you are realistically entitled to. Seller financing can bridge valuation disagreements. We do this on many occasions. And most importantly, it can demonstrate confidence that the seller has in the business. Here's an example. We represented a manufacturing business with a target price of its value of roughly $4.1 million. But because of some customer concentration issues, the potential buyer felt that the business was worth closer to $3.7 million. Now, initially, the parties were too far apart for us to negotiate closing that gap. But the seller stepped up and offered to finance a portion of the purchase price for a period of 5 years. Now, what does that matter? Well, from the buyer's perspective, the seller financing demonstrated confidence. The seller was effectively saying, I believe this business will continue to perform as it has, even after I leave. The result was that the buyer agreed to a higher overall purchase price, which enabled us to close that gap. However, because the seller was now holding paper, he was no longer just a seller. He was now a lender. And this is a completely different level of risk and required significantly more vetting of the buyer, both operationally and financially. Again, the headline number gets your attention, but the deal structure is what determines your reality. So, earnouts. How about earnouts? Earnouts are one of the most misunderstood aspects of structuring a deal. An earnout means that part of the purchase price gets paid later, a lot later, and it's based on future performance. The future payment may depend on revenue targets, or EBITDA targets, or customer retention, or contract renewals, or any other performance aspects, or any combination of those. Now, buyers like earnouts because they reduce risk, of course, and this can be particularly important when the buyer believes that the owner's projections are too aggressive, or growth assumptions are uncertain, or owner concentration exists. If you're responsible for 30-40% of your revenue, owner concentration risk exists. And buyers are concerned about that. And so they want an earnout in place so you'll actually earn what you're asking for. And this could be any uncertainty that the buyer may have. With an earnout, the buyer is essentially saying, if the upside is real, I'll pay for it, but I need you to prove it. Now, of course, most sellers hate earnouts because after closing, the buyer controls the operations. Staffing may change. Accounting methods may change. Marketing methods may change. Suddenly, the seller's future payments depend on decisions that he no longer has any control over. An earnout may also require the seller to stay with the business for a certain period of time after closing. This really gives a lot of stomach upset to many sellers. An earnout almost always requires them to stay on. And if they have plans to get on a 52-foot sailboat 3 days after closing, those plans are scuttled. Now, here's an example of an earnout. We looked at a transaction involving a service company where a large portion of the purchase price depended on achieving certain financial targets over the next 3 years. The seller was comfortable because the business had historically exceeded those numbers. But after the acquisition, the buyer added management staff, increased overhead, changed operational system, and actually shifted marketing strategy. The financial performance of the business fell below the earnout threshold. The seller's argument was, well, the business performed exactly as it always had. You changed the model. The buyer's position was, we're operating the business the way we think it should be run. Predictably, this dispute turned ugly and turned ugly fast. This is why earnouts must clarify and define clearly metrics, accounting standards, operational authority, reporting requirements, and dispute resolution mechanisms. If the earnout terms are vague, conflict is almost always guaranteed. I'll say it again. The headline number gets your attention, but the deal structure determines your reality. Now let's talk about something that most sellers neglect to even consider until it's too late, until an LOI is signed. Taxes. What matters is not what you sell for. What matters is what you actually keep. In this regard, it's important to understand asset allocation. In an asset sale, and remember, that's the vast majority of transactions in the Main Street and lower middle markets, transactions up to maybe $30 million or so. In an asset sale, purchase price is allocated among various categories of assets, including FF&E, furniture, fixtures, and equipment, inventory, vehicles, real estate, goodwill, and non-compete agreements. Different categories receive different tax treatment, and the difference can have an enormous impact on how much of that headline number you actually walk away with. Now, here's a simple example. 2 business owners each sell their businesses for roughly $3 million. In one transaction, the allocation heavily favored goodwill, which receives favorable capital gains treatment. In the other transaction, a substantial portion of the price was allocated to fully depreciated equipment and other assets that are subject to depreciation recapture. Even though the headline numbers, the purchase price, were nearly identical, the second seller walked away with a lot less money than after taxes than the first. The IRS doesn't care what the headline number is. The IRS cares how the deal is structured, which is precisely why you need to care about how the deal is structured. The headline number gets your attention, but the deal structure demonstrates and determines your reality. As sellers, and we are generally representing sellers, as sellers our objectives are simple. We want to maximize the cash at closing, the certainty, and the after-tax proceeds. But we also want to minimize the ongoing risk, future disputes, and a dependency on buyer performance. And those goals are achieved only through intelligent and informed deal structure. So here's the bottom line. Most business owners make the mistake of focusing on price, when deal structure is often what determines how well the transaction ultimately works out. Deal structure determines risk, it determines taxes, it determines timing and control, and it ultimately determines how much of that great initial offer you're actually going to keep. A lower priced offer with cleaner terms, lower risk, and better tax treatment can produce substantially more real wealth than a larger offer poorly structured. Remember, the headline number gets your attention, but the deal structure determines your reality. In our next video, the final episode of this 6 Essential Elements series, we'll discuss the closing the deal, and the aftermath. What happens right before closing? What happens during the transition? And what happens after the seller walks away, including something that very few people consider, the possibility of seller regret. So don't forget to subscribe so you don't miss that one. If you found this video helpful, hit that like button. It will help us out. And remember to subscribe. And finally, as always, thanks for watching. I'll see you in the next video.